Hi friends, welcome to a brand new segment of FinveStocks, Friday Basics, which will give you good insight about Indian equity market. My sincere effort in this segment is to create awareness to all in simple language. This series will be arranged in such a way so as to understand everyone who are beginners. Please share this video to all those who wish to learn, understand and participate in stock market. Please don't forget to subscribe and click the bell button to get the notifications of upcoming knowledge-packed videos on personal finance and stock market. Welcome back to FinveStocks, where we make everyone understand the basics of money management. Before going into this video, make sure you watch earlier videos of this series, which is mentioned in the I button. In our last video, we discussed 50 stock-related terms one should be aware in stock market. In today's video, we will discuss the basic concept of economics, which will benefit to understand the stock market in macro terms and also will help in analyzing the outlook of market as well as sectors and stocks. Let's discuss. Today, I am not going to give a detailed class about economics as I am not an expert in economics. But yes, I learned some basic concepts which are required for stock market understanding. Understanding the basic economic concepts will help you to filter out relevant information of the financial news from the irrelevant one in order to make better investment decisions. So let's understand the basics of economics. So what is economics? By definition, economics is the study of how to use available resources to the optimum level. Economics studies the various factors that affect society, the use of goods and services, the involvement of individuals, businesses, countries and governments. Economics tries to identify and analyze ways to allocate resources so that they can use to the best. Now let's see some of the day-to-day examples. So why some of the department stores are selling consumer goods at a cheaper rates? For example, say DMart. Why DMart is selling goods at a discount from MRP? The answer is economics. Why discount brokers such as Zerodha, Upstocks are giving zero brokerage for delivery of shares? The answer is again economics. Economics is not about becoming rich or studying the stock market or forecasting trends. Economics is the study of we the people and our choices. And it is about how we get our income and how we use it. Economics is about analyzing the choices available with us and having it with all the resources available to us. Economics may typically be divided into macroeconomics, which focus only on total economic development, and microeconomics, which relies on individual consumers and firms. Microeconomics focus on the study of individual decisions taken by businesses, households, workers, etc. Whereas macroeconomics focus on the study of decisions taken by countries, governments, and assess the economy as a whole. Macroeconomics deals with the issues like inflation, growth, inter-country trades, unemployment, etc. Microeconomics and macroeconomics are complementary to each other. Microeconomics is similar to a bottoms-up approach, where business need to be analyzed first, followed by industry and country. Macroeconomics is more like a top-down approach, where the country is analyzed first and subsequently the industry and businesses. Now let's see how to measure the economy. To measure the economy, there are economic indicators available. An economic indicator is a metric used to assess, measure and evaluate the overall state of health of macroeconomy. Economic indicators are often collected by government agency or private organizations in the form of census or survey, which is then analyzed further to generate an economic indicator. The indicators can be leading indicator or a lagging indicator. Leading indicators forecast where an economy is headed. One of the top leading indicator is the stock market itself. Because stock prices favor in forward-looking performance, the market can indicate the economy's direction if the earnings estimates are accurate. The next important indicator is GDP. Gross Domestic Product is widely accepted as the primary economic indicator of any country. The GDP shows the overall size of an economy. The change in the GDP measures the real growth, that means the overall health of the economy. Please click the I button mentioned above to see the detailed video about GDP. The next important economic indicator is the CPI, Consumer Price Index. The Consumer Price Index is the index that is used for calculating the retail inflation. In other words, The Consumer Price Index calculates the change in price of a common goods and services. The goods that are considered for inflation are foods, clothing, transportation, housing, electronics, apparels, education, medicines, etc. CPI is a widely used for measuring inflation in an economy. Rising inflation results in lowering standard of living, and it will result in an increased cost of living. A high inflation rate will result in increase in price of goods, and as a result there will be less manufacturing, which will result in loss of jobs. Other key economic indicators are interest rates, unemployment rate, home sales, industrial production, consumer spending, retail sales, etc. Now let's see some of the basic concepts to understand economics better, which will be handy for stock market. The first one is opportunity cost. Opportunity cost is a concept in economics that is defined as those values or benefits that are lost by a business, business owners or organizations when they choose one option over another option in the course of making business decisions. Consider a business that have two options to invest its surplus capital. Option A is to invest in stock market where they can get an annual return of up to 15%. Option B is to invest in updating its equipment, which can generate a return of 12% over the same period. Finally, assume the company opted for option B, to invest and upgrade its equipment to produce better quality products. So it is foregoing a return of 3%, that is 15% minus 12%, which it could have gained by investing in stock markets. This 3% is called the opportunity cost for the company. The next important concept is the sunk cost. A sunk cost is the cost that has already been incurred by the business and could not be recovered. For example, consider a company that makes basic cricket bat mainly for kids. It makes cricket bat at Rs 150 and sells them at 190 rupees. Due to competition, assume the company has to make premium bat, which will cost another 50 rupees. They have to make the decision on that. Hence, while making the decision, the company will consider only the additional cost, that is 50 rupees, required for making the premium bats. The cost of a factory or warehouse, etc. is not considered because it already has invested money on these items and they are already a sunk cost even if the company produces premium bat or not. This is the concept of sunk cost. The third concept is the trade war. Every nation tries to protect its local businesses, local industry, etc. to protect their own economy. As the local industry creates jobs, they would like to protect the interest of the country's businesses. Hence, countries impose higher tariffs, taxes when the goods are imported from other parts of the world. By doing so, the other countries retaliate with even higher tariffs. This creates a conflict situation called trade wars. The best example for this in the current situation is the trade war between USA and China, where the USA initiated a higher tariff on the goods imported from China and China retaliated with similar tariff on US goods. The last and most important concept which is directly linked to stock market is supply and demand. Supply and demand is the basic law in economics. Supply is the number of goods the producers float in the market, whereas demand is the amount market participants are willing to buy. In an efficient market, the point where the supply curve and the demand curve meet is called the equilibrium point. And it is a point where the supply and demand are sufficiently enough for each other to be met. For example, when crop production increases, the farmer decreases the price of the crop so that they can sell off their produce. Selling the product at lower cost compared to market price so as to get the advantage of selling more units is an economics called the economics of scale. When the supply is more than the demand, price decreases. Similarly, if the demand is more than supply, the price increases. This is a basic principle how price of stock moves. For more about how stock price moves, kindly check the video link provided in the I button above. Let's wind up the video with some interesting economic facts related to our country. The facts are: India has a mixed economy. The Indian middle class is bigger than that of US middle class. Half of the workers rely on agriculture. It's an attractive country for outsourcing. The cost of living is lower than in the US. Bollywood contributes billions to India's GDP. In my next video, we will start with fundamental analysis, which will help to identify stocks for long-term investment. Please do like if you like the video and don't forget to subscribe to get the notifications of upcoming videos on personal finance and stock market. Please post your valuable comments. Do follow the Friday basics to make your stock market journey easy. Thanks for watching and have a good day.